Hello and welcome. I'm joined today by Richard Berner, Clinical Professor Emeritus of Management Practice and Finance, co-director of the Stern Volatility and Risk Institute, and member of Credit Benchmark's Advisory Board. Dick served as counselor to the Secretary of the Treasury, as first director of the Office of Financial Research, a longtime financial economist and someone who shaped thinking on risk, resilience, and transparency across the financial system. Dick, it's a pleasure to speak with you.
Thanks for the opportunity, Christa.
Okay, so my first question is around volatility and trade tensions and market sensitivity. So, with market volatility on the rise again, driven by renewed tariff concerns, trade frictions, and broader economic uncertainty, what types of risk signals should regulators and institutions be paying closer attention to right now?
Thanks, Christa. So I think that the tariff shock, if you will, like other shocks that we've experienced in the not too distant past, exposed some vulnerabilities in our financial system as well as in our economy. And those two things interact. So I think regulators and market participants should pay attention to those vulnerabilities and think about what issues could be exposed by these tariff shocks. Clearly, in my view, this shock is like a big supply shock. We've seen some of those in the past, such as when Russia invaded Ukraine, from the pandemic, which had both supply and demand shock aspects to it. And we saw some of the consequences in both cases. In the event when Russia invaded Ukraine, we saw big impacts on commodity prices, as you expect, as well as through financial markets. And we saw that markets responded to the volatility by becoming somewhat less liquid. Even liquid financial instruments like sovereign debt, particularly US Treasuries, for a short period of time became less liquid. We saw that in the recent events. And I think the lesson there is that liquidity can be fragile, even in the most deep and broad and liquid financial markets. And people need to think about that when they're managing their risk. And policymakers need to think about that and try to make our system more resilient.
Excellent. And if you could comment, what are you expecting? What do you anticipate the impact of tariffs may be?
Well, because it's a big negative supply shock, I think there are several aspects to it that are important. The immediate issue is this going to be something that creates a recession in the US and the global economies? I think the chances of that are greater than 50-50 at this stage of the game. And increasingly, that's becoming the consensus. And that's true even if there are trade deals. It's true even if there are, um, there's some relief from what the April 2nd Liberation Day tariffs looked like, particularly on China, but elsewhere as well, because these things interrupt a lot of the factors in global trade that promoted prosperity and growth in the global economy. And it's not to say that there aren't winners and losers from those developments, but the point is, on balance, uh, increasing global trade, dropping trade barriers, um, and related issues, I think, promoted uh, good things. And this is not likely to be a good thing. So recession is the first instance. More importantly, I think what we're going to see for the United States is are two important things. One is because this is a less predictable environment and one in which uh, the administration has adopted a less favorable attitude towards allies as well as adversaries around the world. It's going to make the investors, would-be investors for the United States, less interested in investing here. And I think that threatens to undermine the status of the dollar as the reserve currency of the world. Equally, I think important is that this supply shock, if it continues, and these attitudes, if they continue, are likely to reduce our productivity growth, our standard of living in the United States. And none of those things are good for any of us, but especially for the lowest parts of our income spectrum and the people who will be hit hardest by these tariffs.
Right. Okay, thanks. Let's move on to a question around credit risk as a forward indicator and independent insight. So, credit risk often reveals signs of stress before other market indicators. In your view, how effective is a forward-looking signal of systemic fragility, and how can chief risk officers incorporate independent, aggregated credit risk insights into their stress testing methodologies to improve scenario planning and overall risk preparedness?
So this is a perfect question for risk management. When I teach risk management, credit risk is one of the four key things that I focus on. I'll tell you what the other three are if you like. But the point is that credit risk can be a forward-looking indicator, particularly because it's priced in markets, and the more information we have about credit worthiness, the better. So it's a perfect question for a credit benchmark call, where credit benchmark takes advantage of survey information to try to inform investors and issuers about the creditworthiness of, uh, people with whom they might have as counterparties, regardless of whether they're publicly listed or not. And that's one of the huge benefits of that. We try to do that in a variety of ways. There are clearly other ways, like using market information and CDS, credit default swaps, and others. We know also that the volatility we just talked about has an important influence on perceptions of creditworthiness in the marketplace. Because, if I buy a corporate bond, it's buying a put on the probability of default of that issuer. And so that optionality involves a volatility component in thinking about its price. When volatility goes up, credit spreads are going to widen, even if the underlying creditworthiness of the issuer hasn't changed. And I think that's really important for the investor. It may be that at a peak level of volatility, there are opportunities created by that. But I think when volatility goes up and credit spreads widen, credit becomes less available. All those things change financial conditions in ways that are not favorable for credit investors or for credit issuers. So I think that good risk management involves taking account of those factors, and that's important. And say one last thing, which is the three other issues that I focus on in financial risk, namely market, liquidity, and contagion. These things are all interconnected. And they constitute, if you will, part of financial conditions. And they can all be monitored in real time. That's something we try to do at the Volatility and Risk Institute. And risk managers and policymakers to try to get ahead of some of these things routinely stress test their portfolios, stress test financial institutions, stress test markets in order to see what the likely impact of a stress event is going to be on creditworthiness and to get ahead of where they suspect that things might be risks and to see what the impact might be. All that's part of good risk management.
Great. Okay, thank you. Moving on to second order and cross-sector risks. So as credit activity continues to grow outside of the traditional banking sector, how should we be thinking about second order and cross-sector risks? For example, those indirect exposures that can ripple across insurers, funds, corporates, and beyond.
Great question. We just had a conference a couple weeks ago, and this has been a topic of really active discussion since the growth of private credit and private markets has been so strong over the past few years. And what's important is that this is not just a separate asset class or group of asset classes that is immune and distinct from the rest of the financial system. On the contrary, what we've learned, especially from a paper produced by two of my colleagues and a researcher at the New York Fed, that banks and private credit firms, as well as other non-bank financial institutions are even more interconnected than they have been in the past. As an example, we see um, banks providing liquidity and leverage to some of these firms. So the firms on them by themselves may claim that their leverage is low, maybe 4 or 5 times compared to banks, but they are less transparent in many ways. They do offer lots of advantages because they can specialize in the way that they manage their portfolios, and they produce high returns. But what we don't know, because they are relatively opaque, is exactly where the risks are in their activities. And what we are starting to find out is that because they are highly interconnected to banks, if there's a problem in one of these firms, it's going to affect their lenders as well as the rest of the financial system. So we need to look at these firms not in isolation, but as part of the whole financial system, and to think about what the potential contagion risks of problems in one part of the system affecting the others are concerned. So that's one important aspect of it. I think another, from a policy point of view, is to say, um, it may be that transparency is not the friend of private credit, but I think from a policy standpoint and for the investors, transparency is something that is always to be valued. Without it, it's hard to make decisions and hard to understand where opportunities as well as risks may lie. And so I think we need to look for a balance between what these firms do and how they operate and make money, and what's good for the system and for the financial system as a whole.
Okay, great. Thank you. Follow on to that. Do you think current regulatory frameworks are keeping up with the new complexity with the private entrants and additional players? And how useful would a forward-looking consensus view like credit benchmarks, which spans sectors and highlights correlated credit transitions and helping to uncover those risks that might otherwise go undetected?
That's a great question because, it's perennial. This is regulation and oversight really have always scrambled to catch up with developments and innovation in financial markets and in the financial system, as well as the economy. That's always a challenge. Um, Market participants typically are better compensated than the people who are involved in regulation. They are often, they outnumber the people who are involved in the oversight and regulation. But that doesn't mean that we should, throw up our hands at all. I think there are a couple of things that are important. One is, as you suggested, better information, such as what we get out of the surveys from Credit Benchmark, can certainly help in forming opinions. Equally, we think that you can see in market information, even though these firms may not be listed, some of them or their portfolios may be opaque. Sometimes you can use market-based information to get timely indications of changes that are going on. Third thing I think is important is that it's important to have a dialogue between regulators and those they regulate, or even those they don't regulate, so that they can understand where market developments are taking the system and where risks may lie. That's something when I ran the Office of Financial Research, I tried to really do that to get input from market participants and people in the industry, having worked there for 30 years, that I found very beneficial in not just directing our research, but understanding where the puck is going, if you will, because
Mm-hmm.
that's really important in thinking about where risk is evolving. So I think all those things are important, and it means uh, that you need to do that without compromising the integrity of the oversight and regulatory process. I think you can do that, however, without being captured, and I think that's pretty important.
Okay, excellent. All right, moving on. Capital strategy in a shifting risk landscape. With risk dynamics evolving rapidly, how should institutions adapt their capital allocation, provisioning, and modeling practices? What's the role of more differentiated or real world credit perspectives in informing those decisions?
That's a tough question because it's got many answers. I think it means that you need to focus really hard on your risk management, make sure it is focused on the things that are changing and how they're changing. I think it means second, that scenario analysis and stress testing have to become an important part of risk management. As a teacher of risk management and as a participant in it, I think a really simple framework, but one broad enough to capture things is always important. And that is first you need to identify and then you need to measure risks. If you're working in a group, which you typically are as a risk manager, you need to think about communicating those risks so that if you think things are changing, you need to communicate what you think the changes are and what their implications are for people who are holding positions or managing risks or who are issuing, and think about where the risks and counterparties lies. How about their counterparties, and those issues. So the interconnectedness aspect of it is pretty important. And then last, you got to make a decision. That's what risk management is really about. Doing nothing is really actually making a decision not to do anything, and that may expose you to risks. So you constantly need to be thinking about where things are going, and rely upon both the information that you've got from your analysis as well as your experience in making those judgments. And I think this is an important and potentially risky time because while markets seem to be pretty healthy and strong, after the Liberation Day shock on April 2nd, we've seen a big rally in risk assets. We've seen credit spreads narrow somewhat as a result. We've seen volatility both in equities and fixed income, bar a variety of measures come down. And now everyone's waiting to see what the fallout from these developments might be. And of course, these developments are still uncertain, so the uncertainty itself is a factor to be dealt with. And so I think given that uncertainty, the importance of various scenarios, I think is pretty important to help decision making and to stay on top of where risks might be evolving.
Right. Okay. Good. I think it's a good segue into my last question, which is around building system-wide resilience through transparency. So you've long been a proponent of transparency as a cornerstone of financial stability. What steps, whether regulatory, institutional, data-driven, do you believe are most critical right now for enhancing that system-wide resilience?
So for the areas of the financial system that are new and innovative, I think it's pretty important that dialogue that I referred to earlier takes place. Um, even if regulators don't have specific authority to collect information or to collect reports from institutions, I think it's important that they keep apprised of where things are going and where the new developments are, and that they follow up on leads that might give them information about where these developments are. And what we see going on right now in markets, as an example, is that while those markets seem to be healthy, I think there are a couple of things that are going on. One is if these supply shocks economically, we talked about earlier, result in higher inflation, keep rates high, the uncertainty keeps rates and risk premiums high. That's not likely to be favorable for people who need to roll over their maturing debt, their maturing liabilities. Some may have difficulties. And as a consequence, I think default risks are increasing as we go forward in time. That's especially the case if we also see at the same time the macroeconomy weakening, and there's pressure on earnings, there's pressure on top line revenues, there's pressure on margins. Those things are going to make it more challenging for the weaker credits. So, it's a classic time to up in quality. for the investor and for the issuer. And it's a classic time to be careful because while these may be the best of times on the surface, that's when lenders make their worst decisions. And I
Hmm.
think that old adage, I think applies in the current circumstance. And
Excellent.
it's true across, Krista, it's true across the financial system. And when you think about the interconnectedness that I described earlier, I think about the potential for contagion, for risk to spread from one part of the system to another. With as many moving parts as we have, and as many challenges from shocks around the world that we face, not just tariffs, but ongoing conflicts in the world, ongoing fragmentation in various parts of economic activity, of which I think the protectionism and tariffs are an example. It's a good time to be a little careful about credit extension and credit investing.
All right. Excellent. Thank you. Thank you for sharing your insights. This has been fascinating as I expected and have been looking forward to. So as we continue to navigate this complex environment, your perspective on how we build a more resilient, transparent, and data-driven financial ecosystem could not be more relevant. So I really thank you for your time and for your insights. And we
Thank
will
you,
leave it
Krista.
there.
Yeah, thanks for the opportunity. Appreciate it.